Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So in the latest episode of the Moneymakers Investment Trust podcast, I have the chance to talk to Ben Guest, who is the lead manager of the Gresham House Energy Storage Fund, which has been listed on the London market as an investment trust since November 2018. Currently has a market cap of around 415 million, but trades at a significant discount. The last NAV I saw was about 115p, share price currently around 73p. So it's been, I think we can use the word rollercoaster ride, we use that a lot, but it's certainly been true for your trust with knobs on, so to speak. When you listed in 2018, obviously you listed at around 100p. Shares rocketed up significantly over the next few years, reaching something approaching 180p or even more maybe. And since then, they've been in a deep dive, and then they bottomed out at around 40p and have now started to pick up again. As I said, around 73p now. So it's been a very mixed picture. And I think I have to start by saying, last time you're on the podcast, which was in November 2023, you gave me a number of reasons to be positive about the outlook for battery energy storage. And we can revisit some of those. But in practice, what happened was that the next 2 years were basically very difficult for you, 24 and 25, because the revenues you've received nosedived, and the board decided to suspend the dividend and launch a strategic review, the fruits of which we're now seeing. So before we come on to talk about why the performance of the share price has been recovering, is we just talk about what actually went wrong compared to that last time I spoke to you. You know, why did the revenues fall off a cliff, and why were you forced to suspend the dividend when the outlook at the time, as you described to me, still seemed very positive?
So almost speaking to concepts, the use of batteries is to balance supply and demand, with the supply becoming increasingly intermittent, and of course demand fluctuates intraday and seasonally. So as we spoke at that time, roughly, what was happening were two things. Underlying gas prices had peaked and were drifting downwards. And so volatility in the market had peaked. And we'd fairly recently gone through our strongest trading period that we'd experienced to date. However, most of our trading was in something called frequency response. It's a core part of the market. It effectively helps maintain the electricity at 50 hertz and maintains effectively the quality of the electricity. And batteries are needed for that, and we're ushered into the system for that purpose. But that's a much smaller part of the market than the long-term energy requirements in terms of sort of providing either the absorption of the excess or release of what's needed when there's a lack of supply, which is needed all the time. And as the frequency response market saturated, if you like, it was naturally saturating, and we've been saying that since our IPO, and now it's well and truly saturated, because the need for frequency response is somewhere between 1 and 2 gigawatts, and we've got 7 gigawatts as of today. So no surprises there. But government wants batteries to get up to 22 gigawatts, and that's excluding long duration, which is expected another 7 by 2030, give or take. So the government agrees that we need lots and lots of batteries, and that is primarily for this purpose. However, at that time, and still today, the batteries are not being used fully for that purpose. And that came as a shock to us as we transitioned. We suddenly realized, as we were moving away from frequency response and seeing the pricing in frequency response fall, as it naturally would as it saturates, not seeing the second line of revenues in trading materialize to the degree we expected. And effectively, batteries weren't being used well. The reason why we thought we would be used well is because way back in 2020, during the COVID period, what effectively happened was that at a time when batteries are thought of differently and frequency response was thought of differently, the demand for frequency response was in the 400, 500 megawatt range, and frequency response, lo and behold, saturated in that time frame. And so we made a bit of a fuss about it then, and we ran a trial with Natural Grid, ESO as they were at the time, now it's NESO, and they ran a trial, and we were given a chance to run head-to-head with gas assets and demonstrated our competitiveness, and we expected things to get fixed in the interim, but they weren't.
So let's just focus on that point, if I may. Why did they not materialize as expected? Is this all about connectivity to the grid?
No, it's not a physical grid issue. It's a control room issue. So, you've got a physical grid, and what you hear in the press a lot about is constraints and or bottlenecks. That's because we're putting generation in completely new places where the grid is not there. So you need to reinforce the grid and deal with that. That's a physical grid issue. where physical constraints do cause issues and need to be dealt with. What I'm talking about is the company, the entity that makes sure that what's flowing over those cables is balanced at all times to make sure that the customers get the power and not more and not less, and no systems break and you don't get outages, is the system operator. And that system operator has used gas, which is something you can dial up and down every single day. And it is dialed up every single day to the tune of usually north of 10 gigawatts up and down, at least once a day. And they didn't transition and have not transitioned, even at the margin in terms of what batteries can offer. They have not really started to chip away at the use of gas in the way we'd expected, even then or even today.
Right, because at the time when we spoke in November 23, you talked about the problems of balancing the grid. It was too complicated for a human being to do. Not enough time and not enough fingers, you said. So basically, for ease and convenience, they just went to gas all the time.
That's right, exactly.
But you were confident, well, you said you were, that there was a new system coming in December 23, so around then. So what's happened to that new system and why is it not delivered?
Well, I mean, that system did come in. It's called the Open Balancing Platform. And I think what we expected from it was far greater than what came of it at that time. Let me describe a little bit of what it is so that you've got a feel for it. So, what did come in was an operating system or operating platform, which basically is a data platform that allows software to run on it. You could think of it as a commercial services are really pieces of software. So frequency response can be traded on it. The trading of batteries can be carried out on it. And one thing that came onto that platform in terms of service or software was something called the bulk dispatch optimizer. So it aggregated all the batteries and could then dispatch all the batteries when they needed. If you're worried about the ability to cobble together all the batteries that could take the place of gas, and you have this as a solution, then you could press an aggregated or bulk battery button instead. And they do have that ability now, have had since then, but they have not really prioritized batteries. So what's been happening in the background since then is a full revolution of the control room. This OBP is becoming the operating system for the entire set of services that can be used by the control room to balance supply and demand in every single time frame, whether it's sort of quality, frequency response timeframes within half-hourly periods, balancing mechanisms, so on, all the way out to longer periods, and also reserving. So it's becoming the new system, and it's replacing 2 or 3 different legacy systems. So that's an important set of technical upgrades. There's one other thing that's happening as well, which is very important. In early 2024, the control room went from seeing as a battery as being capable of operating for 15 minutes. Shortly thereafter, from March 2024, it went to assuming that batteries are capable of operating for 30 minutes. But the key point is that it's making an assumption. Why? It's because it's not been able, and still today, cannot see the state of charge of a battery. So everything else in the control room is you turn it on, you run it for as long as you like. A battery, you have to know how long it can do it for, whether it's importing or exporting. So the state of charge measurement and visibility of that has been missing. Now, there's been an Ofgem regulatory change that was approved last year, which was meant to be approved 2 or 3 years ago, but is now finally coming in. And technically, it's being implemented by June of this year. That is going to allow the control room to see that a battery has potentially 2 hours in terms of ability to charge or discharge. Depending, whatever it's got, it will be able to display. And so that is a sort of fairly seminal event in terms of being able to really utilize batteries to their fullest.
Will it actually happen? We've had enough full storms here.
It's promised in June, and I would assume there's going to be a short delay, but it is expected in June time. I do think there remains a further challenge. So you've got the technical requirements pretty much in place. You've got bulk dispatch batteries, if you like. You'll have all the regulatory requirements, ticked, and the ability to use batteries properly as well. With the passage of time and learning more about what goes on in the control room and the challenges, I do think there remains a challenge in terms of the mindset in the control room, which is the confidence in the use of batteries. And that speaks to the fact that gas is such a tried and tested thing that there seems to be no huge hurry. I mean, and I don't want to sort of say that they're being lazy for a second, because they are working very hard, and my attitude and comments about NESO have changed. They've achieved all of this. They had a budget signed off by Ofgem, they spent the money, they put things in place, the regulatory changes are in place. But I still worry that
fundamentally, if you step away from what we do and just step up a level and go, what does the system need? What does the electricity network need? And if you look at what's already there, you have renewable generation, on average, generating somewhere between 0 and 200% of the expected 100% at any moment in time. So that's the degree of intermittency. So if we end up with 30 of our 40 gigawatts of demand, approx, being generated by renewables, that could be zero generation, it could be 60 gigawatts of generation. And that really indicates how much flexibility you need in the system. Now, you can store up the batteries and you can discharge the batteries. So if you had 30 gigawatts of storage, you could actually deal with huge amounts and huge percentages of the challenge, a set of challenges in terms of the amount of time that batteries would solve the problem. But, and this goes to the resilience of the system, which is a whole category of thinking around it, how do you deal with longer periods of weak renewable generation and so on? And that's where I think the mental block lies. And I forgive any sort of person at NISO listening to this or anyone else at Ofgem. It's the challenge that remains, which is how do we get our heads around being able to turn this gas off? Because at the moment, we have a historical gas, nuclear plus biomass, let's call it the old Drax power plants system, that can meet 100% of demand. So you could completely do away, if you were to refresh all that gas and biomass and so on in due course, because it'll reach end of life eventually. But you could do away with all the renewables and batteries, and the system would still run. That's the degree to which the resilience challenge has lied in the background, because one of the three top priorities for NISO is to keep the lights on. And it would be naive of us to think that they're going to turn on batteries and use batteries without that problem somehow solved in the background. Put it this way, they may use batteries, but they won't be able to turn off the gas, because instances where batteries can't solve the whole problem will remain. And so how do we deal with this fundamental problem? And I do think it's actually solvable. And really where it comes from is understanding that batteries can provide power for long, long periods of time. And this is one of the things that this regulatory change will allow. It's so long as they implement the mindset change, which is to essentially use batteries as much as possible. And if there's going to be a relatively long period of low generation of renewables, squash them into a pancake, run them for a day or two, and then therefore reduce the reliance on gas. And then when the renewable generation comes back on, the batteries charge up and they could go again. Now, in that instance, batteries will contribute a relatively small amount. And that just highlights the fact that we do need a lot more batteries to deal with the removal, if you will, or the allowing of going offline or mothballing of gas plants. We've been analysing this for a long time. And since we last spoke, we've done a lot of modelling in the system. In other words, what we've done is put the future renewable generation fleet, which is made up of thousands of turbines all around the English and Scottish coastlines and onshore, and run them against expected levels of demand. And of course, it's prone to error, but you can run a set of scenarios. And what that highlights is that when the greatest imbalances, both in terms of time period and in terms of extreme power levels, effectively highlight the system need. How much do we need if we want to fully replace or very, very significantly replace gas? And we get to a similar answer to the government if we're inferring what they are announcing now. They're saying, let's get 22 gigawatts of 2-hour batteries and 7 gigawatts of long-duration energy storage. We think that actually we need 30 gigawatts of long duration. So all those shorter duration batteries should extend themselves to a 10, 12, 15-hour duration in due course. So we're on that journey. But to really be able to progress on that journey as a fleet, ourselves and our competitors, you need to have the confidence that that mindset shift will happen so that we can chip away at the use of gas rather than expecting at some moment magically in 2031 or 2, where there is enough confidence and enough batteries that the old gas will be turned off and the batteries will be turned on. Because by then the investment case will be shot and people won't have the confidence to invest in batteries. So this is a live debate of where we are. And the utilization of batteries is improving hugely. The revenues have improved hugely from the H1 2024 low, and they've recovered very significantly in H2 24, I think further in H1 25, and then this sank a little in H2 25, but partly for seasonal mildness and other reasons, not just sort of poor utilization. And so our concern is that the adoption of batteries doesn't keep going, but we are chipping away at the technical, the regulatory, and the behavioral sort of requirements to chip away and move away from gas and use batteries increasingly. because it adds so much cost to the system when you don't use batteries to store the renewable generation that doesn't show up as a function of excess generation that then can be dispatched during the lulls.
Basically, we're not optimizing the system, is what you're saying, even though it is a stated government policy that they want to increase the amount of battery storage capacity, and they also want to hit this renewables target that they have, which may or may not lead to the lower prices that they say we'll see, which is another issue, of course. So you would have thought that a government that was committed to growth and was committed to its net energy target would be really beating the drum about this and, if you like, forcing the system to adapt both technically, regulatorily, and in the mindset.
And to the extent they were forced or they were willing sort of parties here, they certainly have done the first two. And I do think it is, of course, always just a matter of time, because this regulatory change where the state of charge of a battery is not in place yet. So as soon as it is in place, I'll go like, gosh, all these batteries, all this battery energy storage capacity is suddenly shouting at me from our screens. And that's going to happen suddenly at some stage in the second, more likely third quarter of this year. And there's a willingness, because myself and my peers, the heads of all the battery platforms, have quarterly meetings with the head of the C-suite of NESO to discuss this, as they must also with other generators and other types of technology. And so there's a willingness to keep chipping away, but naturally it's taking longer than we'd like it to.
Well, that's putting it mildly, I think. I mean, just to go back, obviously this has not been an ideal environment in which to operate, but your premise when you started was that there would be significant increase in demand for battery storage and it would be utilized and you would be in the forefront of actually making that happen. You're still the largest provider of battery storage in the UK, something like 15-20% or so of the total. So it must be very disappointing to you that we're still here. Okay, your NAV has gone up from 100p to 115p or so, but the share price has not kept pace. And you've been forced to change the strategy. You've had to look at your balance sheet, you've had to scrap the dividend for a while, and so on. So we can't yet declare victory, shall we say, for your trust. Far from it. It's still produced a negative return so far.
And my message to NESO, Ofgem, DESNZ has been, use our share price as the bellwether for how well you're doing, because we know that we deploy batteries at an attractive return based on the forecasts that we know are possible if batteries are well used. And dare I say, are probably too low if batteries are really properly used, fully used. And so for as long as our share price languishes below the NAV, I think it's a strong message to whoever's listening that batteries are being let down. That's my view, because we are an operator of batteries. And sorry, let's just go to NAV quickly. The NAV is a discounted cash flow of existing capacity. Of course it is. We're trading at a huge discount to that. But we think of ourselves as a rapid growth company. We've grown from 70 megawatts to a gigawatt. We were not just hoping, we are going to grow to the announced 1.75 odd gigawatts that we're planning for our 3-year plan. We are underway with 500 megawatt hours of augmentations, which will be completed this year. This is enormous capacity growth. And we expect to extend that growth beyond the 3-year plan. Our 3-year plan that we announced in late 24 is a template for further growth. So there's a lot of positivity there in terms of capacity. Then the one challenge is the rate of revenues, the unit rate of revenues per unit of capacity. And that is what has disappointed in the past, and is still disappointing, but not as much, and is expected to recover and grow. But the market is not believing it. So there's no confidence, as far as I can see, or very limited confidence, that that is achieved. We are very confident that it's going to get there. A lot of the gas assets are reaching end of life in a short handful of years. There is a solution needed here. It's clearly challenging that it hasn't yet. And there's an extra piece, which is jumping in with this, is, our 3-year plan had 3 prongs to it. I've mentioned 2, which is capacity growth, augmentation, and new pipeline. But there's a third piece, which is alternative revenues. Now, we've been quite cryptic about this because it is so commercially sensitive, but we believe that we can make good money from alternative revenues. And we do believe it's scalable. And we do believe it's a strategy that we'll implement in tandem for as long as batteries are underutilized. So we look forward to saying more about that in the relatively near future. And we'll probably say a lot more at the annual report.
Sounds very mysterious.
It's not really. It's just commercially sensitive.
Well, the annual report's coming out in about 3 or 4 months' time, so you're saying?
In 2 months' time, in April usually. It always has, so we haven't got an exact date. So this is something we've quote-unquote promised the market. Something we've sort of talked about publicly. We ran our first trials around it in 2023 as well. And we've been running further trials, so as indicated publicly, again in RNSs, and we think we've got a way forward on this.
Okay, well, we'll have to wait to see what that is. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. One of the reasons perhaps why shareholders are not taking time to react positively to the outlook is because of what's happened. And the original model you had, which was based on a high dividend and reaching certain targets sooner, I guess, and revenue targets, and you had some optimistic, what have turned out to be or look like optimistic power price assumptions at the beginning, which were built into your NAVs.
Revenue curves, I would say.
Revenue curves, okay.
Well, it's the volatility of power prices, not the absolute prices, but yes.
Okay, but the absolute prices have also been lower, right?
Yes, but that doesn't necessarily affect us dramatically if there's volatility in the system. Clearly, high gas, especially shockingly high gas prices like we had in 2022, create more volatility, naturally.
You like volatility, basically, is what I think you said last time.
It's a natural feature of an intermittent system, which is why batteries should be able to commercially trade and do well and help the system deal with it. As a result, it's the right solution.
So if I look at what's happened to your trust since you launched, I imagine that a lot of the demand at the outset, like a lot of the other alternatives, was based on the high yields and the high sustainable yields, as it was thought, and in your case, growing over time. And obviously that hasn't happened. So you must have seen some migration in the share register, and you're looking for new sources of demand, effectively, for those who were buying your trust because it was a yield play. You're now looking for people who want to invest in a growth play, essentially.
Yes, and I believe that probably a significant percentage, the vast majority of those that were yield-seeking investors have now sold or accepted the new reality. Given the nature of the share price performance, initially the disappointment around dividend led to very strong selling, unfortunately, a low bottom, and we've had a recovery since as we've demonstrated a few. Well, first of all, the 3-year plan I don't think got any credit initially because it sounded probably a bit crazy to some people. How can you grow when you've got this situation going on? But the combination of falling battery prices, the ability to strike floors, the renegotiation and refinancing of our debt, securing of additional capital, the confidence in securing additional capital for closing out the financing of incremental pipeline growth. We feel that we've got all of that. There'll be some believers and some wait-and-see investors in there or people standing on the sidelines to wait and see. But we feel that we've got all of that coming. We've said as much in terms of indicating what we plan to achieve with our 3-year plan. We've got the alternative revenue piece as well, and that should fill the gap where revenues are disappointed elsewhere. And on we go. We can hopefully start to be believed to be a growth company.
You mentioned the fact that you want people to look at you as an income growth company. And you're sort of implying, I think, a little bit that you shouldn't be looking at the NAV first and foremost as the guide to it, because that's obviously a result of a lot of assumptions that may or may not be right.
Correct. We've recently started to report against EBITDA and indicated free cash flow or EBITDA targets in various different releases. So yes, I think cash flow and EBITDA are key to look at.
So if I ask the question this way, do you think that you might be better off if you hadn't become an investment trust, but you were actually just treated as an operating company listed on the market and were able to issue shares at a discount if you could sell your growth story?
I don't think I want to be an operating company for that reason, because I think we can raise capital at the project levels. So you don't need access to capital at the topco to raise funds. And I'm not sure I want to raise funds at the current share price either. Well, not very much anyway, until people start believing in the story. I think we can raise capital probably more efficiently down at the SPV level. And that's what we look forward to announcing and demonstrating, because there's been a lot of questions around that, no doubt, because, how are you going to grow without all the capital that you need? And, we don't announce things, in a future looking sense without confidence that we can do that. And a big element and ingredient of that is raising the capital. So should we have been an opco? There are various different platforms. We'll see which end up being the most successful. One is obviously being investment trust. One is being a private fund. One is being an operating platform. Several of our competitors are actually in that guise, funded by private equity as operating companies with vertical integration in terms of development, sometimes trading as well, and sometimes with other offshoots of their business models. But we'll see. There are always constraints in the different models that you adopt.
One of the other issues about the renewables generally, but perhaps less so than in the case of the battery storage companies, is if the share price is wrong, why aren't people coming in and buying up all your lovely assets? And we saw that there was a deal for one of your peers in the investment trust space, Harmony Energy, which went out at around NAV, I think. So is that something that concerns you? Why hasn't anybody come in and tried to take you off the table, if you like, if everything you say is correct?
Who knows? That may yet happen. But we are conscious that there are increasingly near-term value-focused activists, if you will, investors on our share register. So I do think there are some investors out there that see the discount, appreciate those that will, to some degree, believe the growth, trust the team and their ability to execute. And we'll see what unfolds from here, of course. I mean, we're not in control of that. But I do think that across the board, I won't say any names, whether it's investment trusts in the infrastructure space or in the equity space or listed equity space or elsewhere, activism's on the rise, and the wish to close discounts, and the reality that the UK in general trades at discount to other international markets is leading to more focus on companies like ours and many others.
Well, obviously, we know that people like Saba Capital are looking at alternatives now, and indeed looking at you.
I'm not aware of them being shareholders in our trust, but they may be. I am aware that they're shareholder in one of our peers.
Indeed. But just suppose someone came along to you and said, well, look, you haven't done enough to close the discount. We want to wind this thing up, or we want to sell it, and we want to return money to shareholders. What would you say about that? I mean, you'd be saying then that the NAV is at least correct, and maybe it's worth more than that, wouldn't you? I mean, in other words, if you tried to sell everything at the moment, what would the price be?
But trying to wind up a trust, especially asset by asset, is never a particularly wise thing to do because you're putting a for sale sign. And so unless you do it in a very intelligent way, and I'd argue that Harmony did that, either they were lucky or they were very smart or a combination in terms of what they achieved. Clearly, in my opinion, the shares are not worth anything like the underlying asset base. We know that we will get built up to our publicly announced 1.75 gigawatts. We believe we can achieve a certain revenue rate against that. We know that that throws off a certain amount of EBITDA and free cash flow. We know that our business is comparatively much more protected against repeats of H124 as a function of our contracted revenue base in terms of floors. So all of that just points to an EBITDA or free cash flow number, depending on what level of analysis you want to do, in 27 and 28, 29 that we can see, especially with the alternative revenue on top. You can add it, you can take it away and have the sensitivity and trust curves and sensitize those as well. And almost under any measure, you see that the assets are undervalued or the portfolio is undervalued if you believe that we can execute any of that. And we're proving it. We've got the funds to do augmentations. They're well underway. We'll be announcing further at the annual report stage, potentially can't lead the market. So we'll be announcing in due course. And then, of course, in terms of getting things underway, again, unfortunately, NISO is also causing some delays on the queue side of things. So we can't start building until we have our grid offers back on the queue reform process that you may have heard about. This review of the whole queue, which is meant to accelerate things, I'm sure will in the long term, but in the short term, it's absolutely causing a snarl up and we can't get anything started. But as soon as we do, we've got all the financing ready, well, off we go. And it's not a very long delay. And in fact, last Friday, the 13th, NISO announced a revised timetable for the release of these grid offers. And I hope they can stick to it this time so that we can actually get underway and get building, because we're going to have our first 3 projects underway, which is 400 megawatts in construction with connection dates that we'll be clear about in due course. We've indicated this 27, 28. So there's a lot of capacity already visibly there due to kick off. So short answer to your question is, if anyone comes knocking, if you will, we can demonstrate the growth. We got the plan. And if it ends up being bought by somebody, who can create the excitement to maximize value for shareholders in that moment. But we do think that the growth plan and continue to execute against that is the key thing. Just to sort of wrap it round in a different way, we've had no issue proving to the market that we can grow capacity. We have had very big issues with our revenues. And if you get, I don't know the numbers off the top of my head, but it's in excess of 50p of headwind in curve reductions since our IPO, in excess of 50p. So you can see what the NAV would have been, and you could hazard a guess as to what our cash flow might have been, were we properly used. So this is very much a macro issue. I do think it's a matter of time. It will get solved, but it does need to get solved. And we do need this bellwether grid, hopefully, the only traded UK only focused, GB only focused battery operator to see a bit smaller discounts. And until it doesn't, then the message to others, given that we've been able to execute on every aspect apart from the revenues and the utilization, that surely a big part of this lies at the door of those who drive the use of these batteries. Because here we are with a very strong government message that batteries are at the core of the system, that we need them. And at the other end, we're not using them properly. And the proof that we're not using them properly is very, very clear to see. Anyone can go onto, whether it's NESO's website or another, and look at the historical generation mix. Look at how gas is ramped up and down every single day, and then look for the storage bit. You can't see it unless you squint. It's really, really thin. So it's really clear that we're building more batteries in anticipation of their use as a fleet, but they're not getting used. And you could then say, well, why on earth are you building anything? And a core part of that is we have a mitigation. We have this alternative revenue piece, which will generate the revenues we think that are necessary to justify the returns, while other operators may or may not have that as an alternative, but relying on the balancing mechanism and the wholesale market to deliver the returns in the way that we've been trading and big consultants create their forecast for us, have assumed, is not sufficient until that changes as a reality.
You have talked, I think, publicly about once you've been through this new investment capacity build phase, you could be generating at least 10p a share in cash flow, something like that. That's the figure you've used, I think. And you stand by that. And obviously, if you applied some sort of multiple to that, you would get perhaps to a different number than the current share price.
Absolutely. And that's a free cash flow figure. It's after all debt servicing, which includes principal and interest. It's not EBITDA. So that's a relatively, hopefully, cautious measure of cash flow, of output from the company.
Okay, so the changes you've made there for you in combination with the board in terms of, I mean, you are now paying a dividend again, but it's sort of notional at the moment, I think.
It's notional at the moment, yeah.
It's the minimum you have to do as an investment trust, is that right?
Yes, I'm not going to deny that it's a token dividend at the stage.
So it's a token dividend, but you have signed these floor contracts, so the downside is at least partially protected.
Yeah, no, significantly protected. I mean, partially in terms of the general mid-case expectation, but significantly in terms of servicing of debt arrangements.
Okay, and you've refinanced the debt, and you're just waiting for the system to allow you to do more of your investment than you want to do.
We're waiting, yeah. And not just waiting, right? Been extremely active behind the scenes, and I don't know the degree to which you've seen that from me, but extremely active in terms of engaging with NESO, Ofgem, government, and in different ways, whether it's through trade associations or the press and so on.
What you really need is a nice joined-up political regulatory grid operator system is what you really want. A joined-up approach, essentially, that actually delivers what it's meant to be doing.
Yes, and more narrowly, we just need to get past this point where using batteries proactively is not a threat to keeping the lights on, because I think that's the block, right? And then even more narrowly, hopefully it's clear, the big problem right now is that, I'll just give this example, and this is almost a quote from NESO themselves. When you may need to use gas in the evening peak, for example, or when there's a lull coming in renewable generation, the choice is not to use batteries yet. And there's still not an event that is capable of playing out at that point in time where batteries have a chance to bid in against the gas. So 6 hours before that event, with evening peak, let's say, the decision is, let's turn on the gas just in case, because the batteries might not be there. Well, for me, that's a nonsense. You can commercially contract batteries to make sure they're there. And if they don't show up, you kick them off the system and fine them horribly. Do that. We're happy with that, as long as there was no technical reason for not showing up. You just bind us to that in the same way that if you turn on a gas turbine, they're not going to turn off 2 minutes before they're meant to be there as well. It's the same thing, but that's the mental block. It's like once you've given up the potential to use gas at the margin, right? You're still going to use some gas because you can't have enough batteries. Give batteries a go. Don't just assume that they may not be there. Then there's a second scenario where they may go, we could be using batteries as well. But if that then leads to gas going offline, because it's maybe already there, then at the next peak, the gas would have turned off and it might then need to be ramped back up. But that means that will cost more because the gas turbine's gone cold. NESO would call that an economic skip. In other words, they would skip batteries on purpose to keep the gas online, knowing that it'll be more expensive to bring gas online later because it needs to be ramped up from coal. Well, that's not with the rule. And also a nonsense for this reason as well, which is if you are really worried about that, halve the number of batteries you're going to use, but use half of them at least, run them so you've got that amount still available for the next peak. And so that amount of batteries is available for 2 peaks in a row. There's all sorts of ways of dealing with this behaviorally in terms of system process, human process, behavioral aspects. And then hopefully in due course, full automation. That's the bit that's missing as well. It's like you then fully automate this and let it run like a piece of AI, Just let it do it, get the people out of the way. As long as you've coded it correctly, it'll work and make better decisions than humans, dare I say. So these are the blocks that remain now that they've got all the tools at their disposal. It's a matter of actually just implementing it. And we've got various conversations on this topic that are unfolding, and hopefully we do get there. But it is a matter of time, and it requires a heck of a lot of patience.
Yeah, well, that's for sure. So just on the question of skip rates, I mean, they have been very high, sort of 80% or something, I think is about right. Given those scenarios and the conversations you've been having, where could they go realistically?
It's as long as the battery is on the right side of a bottleneck or a constraint, as they call it in the system. In other words, it's useful, because otherwise it's on the wrong side, it can't get its power out or in. Excluding those scenarios around constraints, there's no reason why we couldn't get it to very low levels. I mean, sub 20%, probably less, probably very close to zero once it's automated. And there are always other reasons, potentially. For example, technically, sometimes a combination of circumstances leads to a particular portion of the network going dark, or the power flowing through it so low that it starts getting cold or has behaving differently from a physical perspective. And therefore, you need to have the power flowing through a certain part of the network. And that means that it's sort of a bit like a constraint, but it's an alternative sort of technical point. It's about maintaining the voltage across the network. So there are various technical reasons why skip rates will remain. But if you've got batteries in enough places, wherever that gas asset was that you needed to turn on for technical reasons to keep power flow, you could revert to a battery instead if it's more competitive. So in brief, you see this big wave, ongoing daily wave up and down of gas use. I see that being the domain of batteries and the use of gas going back to a sort of, comparatively speaking, base load over time. That's the only outcome. And then the gas stays online as needed or on standby, increasingly on standby, to deal with those long duration events where batteries and gas should be running parallel, so that you don't need to keep the full complement of gas to run after all the batteries are being used first. That would be the wrong way around, because then you need the peak power from batteries and then peak power from gas in numbers. Let's say you have 30 gigawatts of batteries and 30 gigawatts of gas. That 30 gigawatts of gas costs a lot to keep online. It's a lot of turbines and a lot of connection capacity. The ideal scenario would be to get that down to 5, 10, 15, hopefully near the lower end of that range. And they become useful running in parallel with the battery fleet once it's all fully built out. And in the meantime, you need more than the 5 or 6 or 10, whatever. And so you gradually chip away at it and run it in parallel as needed. And then some demand response will also help as well.
I'm sure the listeners here are following all this very carefully, and we're happy to take an exam on it later. It is a very complicated subject. One other point I might mention is last year you were, among others, pressing for what's called zonal pricing. So prices could be set within different regions to better reflect the supply and demand balance at that point. That was rejected by the government. That was a disappointment for you as well. Another disappointment for you as well, Vincent?
Well, we just follow logic. We invest in batteries because they're logically the cheapest solution and most flexible. So if you follow the logic on zonal, the key issue that's happened, way back in the 2010s when, let's go for renewables, and we went and built them where they were cheapest to build because they won the contracts. But the additional cost of building out the network wasn't considered. Well, if you do consider the network effects, then by creating zonal markets, think of Scotland as a single market. You wouldn't go and build lots and lots of wind turbines in Scotland if your power price was going to be zero the whole time, because you've built enough for Scotland. So you'd consider building somewhere else. In other words, it creates market signals for investment in different regions, and therefore leads to market forces taking effect in every region. And therefore, considering all the facts, well, you might have more wind in Scotland, but you might have a much weaker network as you do. It's better to maybe, and it's interesting, the latest result of the AR7, a very large percentage of the winners in offshore wind were off the Lincolnshire and East Anglian coasts, rather than in Scotland this time. I'm assuming that's because they were the most competitive, because they were the most confident that they wouldn't get turned off the whole time, because the CFD contracts now don't let renewable generators get the CFD price if they're generating into a negative price environment. So those changes in contracts have led to a different result. So the best way of solving this is to create zonal markets. The alternative is to deal with it through network charging and the spatial strategic energy plan that NESO have released in terms of trying to guide the market to the right amount of assets in each area and so on. But it's always easier to see the market unfold as it can. But, I understand the reasons the government didn't go forward with it. It would have created too much disruption, in addition to all the other disruption we've got in the CP30 being the biggest, and would have sent some negative investment signals, I think, and therefore we've left it too late to do zonal. And we'll see, because there's alternatives. There's something called Reform National Pricing Consultation out right now, and that's sort of the second best option, I think, that's being rolled out, and more on that in due course.
But just to finish off then, so the idea that we're going to get 30 megawatts of battery storage by 2030, I mean, that's not going to happen, is it? That's not really possible.
No. I'd be amazed.
Require an awful lot of things to happen.
You need the larger projects to get going within a year, and only a handful will in the next year. And why within a year? Because lead times on large high voltage equipment, 275 kV and 400 kV transformers, is on 2 or 3 year lead times.
We're at 7 at the moment, right? So getting to 30.
7 in the bid at an average duration of 2 hours. And I think the system will need, assuming levels of demand of about 40 gigawatts, which is up from where we are now, but not dramatically, we'll probably need 30 to 35 gigawatts, depending on how much of that is renewable, at a duration of in excess of 10 hours. So there's a lot coming.
Yeah. Okay, so thank you so much, Ben, for bringing us up to date on the story of Gresham House Energy Storage, ticker GRID. As I say, been a real roller coaster. There has been signs of momentum more recently, and I guess shareholders will be hoping that that continues. But it is, should we say, a complex picture, and it's quite difficult to understand exactly all the levers. So thank you for trying to explain them to us.
Capacity, unit revenues, maximizing both of those, to simplify it for a moment.
Okay, so in terms of average revenues, at the moment we're talking, 75,000 per megawatt hour, something like that?
In terms of the last numbers we've published, it's in that ballpark, absolutely, and that's including of capacity market revenues.
Okay, so thank you very much. That was Ben Guest, the lead manager of the Gresham House Energy Storage Investment Trust.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.